Forced sales and mortgage prisons. Let's have a look. Hello everyone, Florian here and welcome to another episode of Heiser Says. Grab your stein of coffee. We need to have a look at this article from Yahoo discussing, mortgage prisons locked in with the one bank forever. Well, you already bloody are anyway. And forced sales. What every property doomer is hoping that they can get their hands on property forced to be sold by the bank so you can snap up that bargain. Well, let's have a look at what Nicole has written here. So mortgage prisons and forced sales. Now remember, the number of people being forced to go to sell their houses, I think it was 0.5% of the monthly turnover. That was the peak in the last few years. That was the highest month. So I wouldn't call that a significant movement, everyone. Interest rates are widely forecast to go up 50 basis points, and they have, potentially adding another $160 a month to an average $600,000 mortgage. This will take the total additional repayment paid since May to $707. Well, no one should be surprised that we're seeing this. No one at all should be surprised. The problem is some people actually believed the Reserve Bank when they said they weren't increasing rates. And this is a hard, I guess if people aren't following the news, they're not keeping an eye on it, they're just listening to the headlines because they're busy living their lives. I actually can understand how they could not see this. They're not paying attention to it because it's boring. No one cares about it. Yeah, I want a house. I'll be happy. I'll be fine. She'll be right, mate. So some people are going to have some hard decisions. The good news is the Reserve Bank may now sit back and survey its handiwork. 225 basis points of hike in 6 months. 2/3 of economists surveyed by Finder expected it. Yes, well, they may not. They may, they've said in the update, we read through their statement, they're going to continue increasing rates as it needs be. Well, so we'll see how it'll go, guys. The bad news is we're all contending with the expensive effects. But in the bigger picture, home safety front, there are now 3 serious signs for which to watch out for. The 3 signs to get yourself out of danger or falling victim to are being locked out of refinance. Well, that's going to happen to people. There'll be people who have borrowed too close to the edge. Their property will drop in value and their LVR won't be attractive enough for anyone else to take them on. So they'll be stuck in their bank. They may not be able to refinance. So what do you do in that situation? Well, you get to a point where your LVR is attractive enough that you can refinance. So you've got to pay more money. You've got to get more cash. It's going to be hard for some people. But it's not the end of the world. It doesn't mean you lose your house. It means you're probably not using the most effective borrower then. Hey, $18 billion was refinanced in June. Yeah, because none of us trusted the Reserve Bank. That's why. And so many people locked in fixed rates. Lenders slashed variable rates to try and either keep or win customers. What are we talking about here? Yeah. Discounts as high as 2.4%. Yeah, of course. The thing is you still have to be able to afford repayments. So what's this they're talking about here? Okay. Yeah, this is what they're saying. When it comes to a refinance, you really are racing against the clock. So the sooner you apply, the more likely you are to be approved. Remember, the most competitive advertised interest rates for a quality loan product as of today are still down near 3.6%. If you hold less than 20% equity, though, refinancing may not yet be a viable option. You won't be able to access the cheapest interest rates, and you will likely have to repay extraordinary lender's mortgage insurance. Yeah, I mean, why would you refinance if you don't have to? Indeed, in what is becoming known as mortgage prison, with property prices retreating, you may not be able to refinance. Yeah, so what? Okay, if you can't refinance, you just got to stick with the deal that you have. They're not going to force you out of your home if you're making all your repayments. If it's all good, quiet, you keep going, they're not going to rock the boat. Seriously. Being locked into negative equity. Here, people who borrow most recently are in the most danger. APRA data says that in the 6 months to March, $112 billion worth of mortgages, around 176, according to Rate City, were taken out with a deposit of less than 20%. And that's not a happy position to be in right now. And for borrowers who've owned longer, don't forget house prices rose steeply higher on the pandemic. Yeah, I know that. We're going to see an increase. You're going to see a full issue. Negative equity is the term for owing more than the value of your house. It means that should you become a forced seller, you will still have a debt to the bank. Well, the way to deal with that is then just go bankrupt. Seek legal advice, of course, guys. To make doubly sure they're not out of pocket, lender's mortgage insurance protects the banks and not you in this case, but you pay the premiums. So don't become a forced seller. Do make sure you're still able to meet repayments. With anything in money management, there are two main levers, your income and your expenses. Upping your income in any way possible is a beautiful thing. And note there are almost 300,000 new incorporated small businesses since the beginning of the coronavirus crisis, as droves of entrepreneurial Aussies took to side hustles into a significant top-up. Yep. Well, I mean, okay, there's not really any advice there. What's this one? Falling off the fixed rate cliff. In here, this is where you've got to prepare. You've got a time frame, you've got a date. Okay? You've got to prepare. So I'm not worrying about it until 2024. That's when the year when I go off our fixed rate to probably a variable rate, or we'll look at refinancing. Our mortgage isn't that big. I'm not particularly worried. But, I mean, people are going to be prepared, or they're going to learn quick. But the media is going to emphasize the sob stories because that's what gets the clicks. 180 billion in mortgages are rolling off fixed rates in coming months. Many of these were down near 2%, fixed at a time when the official rate was at an emergency setting of just 0.1. It's likely to be at 2.35% today. Yep. A fix may not be an option. Short-term rates have risen dramatically. For example, the Commonwealth Bank has lifted them 140 basis points. Anyway, I mean, yeah. Okay. So, what actually is this article saying? How to avoid 3 cash rate risks. I mean, what's the one here? Locked out of refinancing. I guess they want to encourage you to refinance earlier to try and get the best deal, but there are costs associated with that. And this is all dependent on the quality of client you are. If you're, a doctor with good income, they're going to fight for you. The banks are going to fight whatever they want for you. But if you're a high-risk client with low deposit and not very good income, or not a profession or an industry that their banks are seeing as low risk, they won't fight for you as much. What do we have here? Being locked into negative equity, that may just happen. If it's your primary residence, does it matter? Does it really matter? If you've paid too much, you're too high, you can still make the repayments, you're not causing any trouble, you just keep going, and plan for the next 5 years for property to increase again, which it always does in Australia, it seems to. I don't think we're going to have a calamitous crash like some people are hoping. Honestly, this is going to be the test here. The recession wasn't the test, it's interest rates going up and seeing how Australians can cope with it, how they can deal with it. This will be the test. So you just got to find push your way through, increase your equity by paying down your debt faster if you can. And here's the fixed rate cliff. I mean, everyone, if you've locked in a fixed rate, you go on your bank website, you see the date when it ticks over, when that contract's over. You got to prepare for it. Okay? Be prepared. That's all there is to it. So let's have a talk. What do you reckon, everyone? I mean, yeah, okay. We'll have to. Forced sales are still very low. There's no look at the actual numbers here. Even if people are in negative equity, it's not going to suddenly push them to sell. If anything, one of the advantages of property is quite slow moving, so you don't have the psychological knee-jerk reaction that you have on the markets. And the interest rate cliff, it's coming, but it's slow. It's a slow-moving disaster. We looked at an example yesterday of a young couple that made drastic changes to their life to get their finances under control. Maybe that's what we're going to start seeing. Now the shit's hitting the fan and Aussies need to start pulling their belt tight. Anyway, let me know your thoughts and opinions on that one. Thank you all for watching. Check out my other channel, Heiser Bim and Heiser Says International, for other content I create. And if you want to support us, there are a few ways you can. Financially on YouTube or Patreon, using our referral links at Amazon, eBay, Independent Reserve, or Aussie Broadband, at Pocket Squares, or call us if you need an architect, guys. Have a great day. And yeah, I mean, we're going to be seeing so much fear-based news at the moment. Just let's keep an eye out and send me the sob stories, guys. We have to go through them.